Okay, I'll be sending you an email with the description of the opportunity. The reason I'm coming in as a little bit of an expert in this case is that I've worked for Unilever in consumer goods. I've done sales, I've done marketing, I've done everything for them. And Xenium, we operated a consumer and a liner in consumer business, a health tech business, but at the same time we had the e-commerce side of things. And I've also worked at Shopback. So I've seen this kind of mechanisms and I can evaluate them relatively well. What does this company do? Basically, what we're seeing here is Circular is a company that basically substitutes purchase. You don't need to put all the money. Is this a buy now, pay later? In reality, it's a more complex equation because what it manages is the returns. What it does is once you have purchased through a subscription, the product that comes into the equation of Circular. So obviously this has a high impact in the margins they can charge. They can obviously charge high impact, high margins. In exchange for that, they do need to hold stock. However, the trick is how they manage to unload the stock and what resale value they're obtaining. This is one of the key reasons of their high margins and good and pretty impressive unit economics that we'll be able to see. In terms of this, you can see that they're generating the use pattern, then they're getting the returns, they're refurbishing, they're getting it back into cycle, or they're offloading it to other players that take off the financial risk in exchange, obviously, for a margin. But this is what makes this quite attractive. I would say, in terms of this, what is the risk? It's obviously relatively replicable by e-commerce giants. However, what is it from my experience? They're not going to get into this. An example, buy now, pay later, and other financing options that I was working with at Shopback. The e-commerce giants, they can't go that deep. They especially don't want to handle the specific niche opportunities. Obviously, if it becomes ginormous, they might have to. But generally, they see more like potential partners than competitors because that's not their business. Their business is volume flow. Their business not to manage back-end operations. Okay. In terms of that, why are the unit economics so interesting? Let me show the slides here. Okay, this is the team. Apologies. Here we go. Growth, relatively sizable or not, depends also on the focus markets. They have in Australia and Singapore. I think the CAGR per month are quite good, but I think the differentiators here, the net dollar retention, and especially valuable, the 40% cross-selling to more products. So you start with phones generally, but then you go into tablets, computers, your whole IT world. Once you've kind of used this subscription model, why start to buy products that will become old or will not be recycled? This kind of economics starts to make sense for consumers. Really high contribution margin because basically the subscription per year is obviously much more expensive than to buy the product. However, consumers obtain the same value and can get the latest product. So this is clearly targeted to high end and mid range. And here, this is the beauty of the equation. I'm not just pitching that I love it, but I think this is very interesting. CLTV versus CAC, 9-1. Why is this happening? Because you're not educating consumers. Consumers already buy this product. What you're doing is enabling them to do it in a different way. And this is what makes this economics completely different. What is the second factor that I think is very important? This CLTV versus CAC can be risky. Generally, what companies give you are metrics that you say like, hey, they generally model that their CAC will go down with time, or initially has been very good, but hey, it's growing, but we'll contain it. That's obviously financial modeling. The problem is generally they're trapped in having to spend money on channels that they don't control, especially social media. So one of the key things that we've discussed is they're here to eventually focus a lot on B2B, but especially to work with channel partners like Singtel, and obviously that's in Singapore, but there's another telcos and e-commerce kind of players, because they can be the enablers. They don't want to go into the level of that, handle the stock. However, they are very interested and they have the size to help them grow without having to fall into the trap of having to pay Facebook all the money and then make very little margins. And finally, what I think is very interesting, or one of the strong points, even though the risk, obviously, of replicability. However, as mentioned, I would say there's more risk of another player doing exactly the same and doing a blitzkrieg strategy going to every market. However, they have a really solid team. You don't usually see this kind of seniority and this kind of smaller or growth kind of startup seed startup. So I think this is especially attractive. These guys are a very solid bunch that have worked everywhere in the industry, and I think this makes them especially attractive, or especially attractive to make the opportunity attractive because you know these guys can deliver, or if someone can deliver, or this guy's in this kind of complex setup. Okay, I hope this is helpful, and you'll get the email. Reach back out to me, and they are looking for a bridge round right now. And the last was a seed round, and I think it was a year ago, no, a year and a half ago. And I'll bring up those details of $7.6 million. However, they're looking for the bridge round, which makes the valuation quite attractive for investors. And I think this is a good opportunity. So let's discuss. I'm gonna be looking at it into more detail. I'm gonna be doing due diligence, and I think it could be interesting to work together on this. Thank you, guys.